Silver just gave us one of the wildest weeks in market history, so let's unpack what happened, why it matters, and what could be coming next, without needing a tinfoil hat, even though, ironically, we probably need that silver more than ever. Over the past 9 months, silver's been on a monster run, blasting from around $29 an ounce last spring to an all-time high of about $115 on Monday, January 26, thanks to a perfect storm of industrial demand, shrinking supply, and a healthy dose of FOMO. Then Friday happened. We closed near $78.29, down a brutal 31% on the day and about 22% on the week, which makes this the biggest one-day dollar drop on record and the nastiest percentage hit since 1980. So if your portfolio feels like it went through a spin cycle, you're not imagining it. But here's the twist: even after this smackdown, silver is still up double digits year to date and well over 100% in the last year. So this isn't the end of the story, it's just the part of the movie where everyone screams and looks at the exits at the same time. A big piece of this drama came from the macro side. The Federal Reserve met this week and decided to hold interest rates steady in the 3.5% to 3.75% range, pausing after a series of cuts late last year. Some Fed officials wanted another cut, but the overall message was we're on pause, we're not in a hurry, and we're definitely not committing to a cutting spree, especially with tariff-driven inflation still a concern and growth looking a bit better than feared. For silver, that means one of its favorite tailwinds, falling real rates, is on hold for now, and that opens the door for a firmer dollar and some profit-taking in precious metals. In other words, the Fed basically told the market, calm down, we're not your sugar daddy this year, and silver's leveraged traders suddenly realized they might be a little overextended at $115. Under the surface, though, the most important story wasn't just traders, it was the physical market. COMEX warehouse inventories have been draining like a bathtub with no plug, with total stock sliding and, more importantly, registered inventory, the stuff actually available to satisfy futures delivery, shrinking to just over 100 million ounces even as open interest implies claims on several times that amount. That's like selling 500 concert tickets for a venue that only seats 100 people and hoping no one actually shows up at the door. This tightness helped fuel the earlier squeeze higher, as shorts scrambled to find metal, but once margins were hiked and prices got nosebleed high, it also meant that when sentiment flipped, there just weren't enough buyers willing to catch the falling knife. Add in the fact that the exchange hiked margin requirements by about a quarter, making it more expensive to hold leveraged positions, and the result was forced selling that rippled through the market as algo traders and funds dumped contracts in a cascade. While the paper market was melting down, the physical and industrial side of silver didn't suddenly vanish. Silver is still the quiet workhorse of modern tech: solar panels, electric vehicles, power electronics, and now the AI data center boom are all leaning heavily on its unique electrical and thermal properties. Solar capacity is projected to keep ramping, EV production is climbing into the tens of millions of units, and hyperscale data centers, those giant AI and cloud hubs, are gobbling electricity and power infrastructure at a rate that makes grid planners sweat. All of that uses silver, either in the panels that generate power, the circuits that move it, or the components that keep everything cool and efficient. At the same time, mining supply is not exactly stepping up heroically to meet that demand. A number of major mines are facing shutdowns or suspensions, squeezed by higher energy costs and stricter regulations in key producing countries. New mines take close to a decade or more to bring online, so even if prices scream produce more, geology and permitting politely answer, sure, check back in 8 to 12 years. That's why analysts talk about a structural deficit in the silver market. Year after year, demand outstrips fresh supply, and the gap gets filled by drawing down existing inventories, those same inventories we just talked about being under pressure on COMEX. Globally, it's not just a New York story either. Over in Shanghai, silver futures have often traded at a premium, signaling strong demand in Asia, especially from manufacturers in solar and electronics. China's also been tightening its grip on critical minerals with export controls and tariffs, which tends to keep more of the supply at home and adds another layer of geopolitical risk on top of everything else. On top of that, US tariff policy under the current administration keeps throwing curveballs into the mix. Any new levies or trade flare-ups can hit both the supply chain and industrial demand for silver, depending on how they're structured. So you've got this tension, structurally tight fundamentals and long-term bullish demand drivers on one side, and near-term headwinds like higher margins, a cautious Fed, a strong dollar, and shell-shock sentiment on the other. Looking ahead to next week, the spotlight shifts to economic data and Fed speak. We've got key releases on jobs, services activity, and the big one, non-farm payrolls, along with more commentary from central bankers. Strong jobs numbers and upbeat data could reinforce the Fed's no rush to cut stance, which would support the dollar and potentially keep a lid on silver in the short term. Weak data, on the other hand, would revive recession fears and might push investors back into safe haven assets, giving silver a bid, especially now that some of the froth has been blown off the top. On the industrial side, any fresh headlines around solar subsidies, EV targets, or AI infrastructure investments can quickly remind the market that, whatever the daily chart says, the world is still building a power-hungry, electrified, data-driven economy that quietly runs on metals like silver. For traders and investors, the key levels to watch are whether silver can stabilize somewhere in the mid-$70s to low $80s range and build a new base, or whether panic and forced selling drag it back toward the $70 area and below. Long term, the case for silver as a strategic asset in a world of deficits, electrification, and geopolitical metal wars is very much alive. Short term, the message from this week is that even the strongest fundamental story can get ugly when leverage, margin calls, and human emotion collide. If you want to keep up with how this tug of war plays out, between central banks and miners, between AI data centers and solar farms, between traders on margin and factories that just need metal to keep the lights on, make sure you hit like, drop a comment with your silver thesis, and subscribe so you don't miss the next weekly recap.